Welcome back. You're watching NewsX at 9, and there is gloomy news for the Aam Aadmi on the economic front. The Prime Minister's Economic Advisory Council is flagging off twin concerns for the nation. On one hand, inflation is proving really difficult to contain, and on the other, the Indian growth story is running into speed bumps.
A stormy start to the monsoon session, but as the parties continue their game of one-upmanship, the Prime Minister's economic panel is sounding an alarm.
We project the growth rate for 2011-12 at 8.2%. And the sectoral growth rates are: agriculture will grow at 3%, industry at 7.1%, and services at 10.0%.
India is poised for slower growth. From 8.5, it's expected to slide down to 8.2%. At the same time as inflation continues to be stubborn. Inflation expectations remaining at a high of 9%. What this means is that the RBI could hike interest rates even further, making home and auto loans costly. On the other hand, the growth in agriculture and industry will be slower, while services could expand faster.
Government of India needs to come out with a constructive policy to reduce inflation, control inflation, and not just use the monetary policy measure of increasing the repo or reverse repo rate time and again, which in fact is not reaping fruits for the time being.
It's a crucial period. The global economic environment is volatile, and India desperately needs to attract investments given the double blow of high inflation and falling growth. Shouldn't it be the economy that takes center stage and not bitter politics? Bureau Report, NewsX.
And we're right now being joined by Co-Chairman Aman Agarwal of Economic Affairs Committee, PhD Chamber. Thank you so much, Mr. Agarwal, for being here with us on NewsX. So not really happy news for all the people of the country. Please explain to our viewers how the slowing growth rates are going to affect them. Will it impact job creation, lead to downsizing, or even just slow down wealth creation?
You see, the factor is that in any economy which is growing, one should not forget that 8.2% effectively is equivalent to 9% of last year, because the base goes higher. Since the base goes higher, the growth rate, even if it goes down by a certain basis points, the actual growth rate is almost the same. So if we are able to see a 9% growth rate as against 8.2% for the current year, for the 2011-12, we would see that there will be a tremendous amount of increase in terms of employability, growth prospects for industry, and so on and so forth. However, this figure also does not mean that we are not going to have growth or there will be any kind of recession structure which is famine. What it basically means is that we are going to be stagnating at what we were in terms of last year growth factors, be it in terms of employability, be it in terms of industrial growth, agriculture. If you really look at the report, one major factor which does come out is that we have a huge fiscal deficit coming up to about 6.8% according to the IMF definition for both center and state. And the government needs to take due corrective steps to control that and to induce factors which can both increase agriculture as well as industrial output, which are projected to be almost half of what they have been in the last 2010-11 year.